Welcome back to Investing Talk Podcast.
Today, we are looking at Sellas Life Sciences Group.
Ticker SLS.
That's the one. And honestly, if you're looking for a masterclass in high stakes, high reward, and, well, let's be honest.
High anxiety.
Exactly, high anxiety. This is the case study for you. We're dissecting a clinical stage biopharma company that has posted a massive one-year return of over 323%.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm find us. Okay, so over 300% in a year.
That's a huge number.
It is. And usually when I see a chart go that vertical, my too good to be true alarm starts ringing, you know? It just screams bubble or a pump.
And that skepticism is healthy. It's smart. But here, the context is a little different.
How so?
We're sitting right on the edge of a major event, a phase 3 reveal.
So this is the definition of a binary outcome.
It absolutely is.
Yeah.
This could be a blockbuster in the making, or it could be a total heartbreaker.
A rocket ship that might reach orbit or just explode on the launch pad.
Yeah.
Okay. I'm looking at the numbers you send over, and I want to start with the cold, hard reality here.
Let's do it.
We have to talk about the fundamentals. Because, strictly speaking, this company doesn't make any money yet.
Well, that's the classic biotech trade-off, isn't it? You're paying for the potential, not the present.
Right, but let's unpack that present first. Because the fundamentals are stark. Sellas Life Sciences. Revenue.
Zero.
Zero. And I don't mean low revenue. I mean zero trailing 12-month revenue. They are purely pre-commercial.
Which is standard for this stage of development. If they had revenue, if they had an approved drug on the market, the stock price wouldn't be anywhere near where it is now.
It'd be 10 times higher, sure.
Yeah.
You're buying the risk of that zero.
You are.
But the burn is real. Net income is negative $26.26 million.
Over the last 12 months, yeah.
And their earnings per share, EPS, is sitting at negative 32 cents. Now, I will give them this. In Q3 of 2025, their EPS was negative 6 cents.
Which beat the consensus.
It did. It beat the consensus of negative 8 cents. So they lost less money than Wall Street thought they would. But losing less money is still losing money.
You're looking at the income statement, which is important, but in biotech, the balance sheet and liquidity are where the real story lives. You have to look at how they're keeping the lights on.
Okay.
And this is where the story gets really interesting. They recently had a significant liquidity event.
You're talking about the warrant exercises.
Exactly.
Okay, hold on. We need to pause here and explain this because warrant exercises sounds like some boring financial jargon, but it's actually critical to the bull case here, isn't it?
It absolutely is.
So for anyone listening who hasn't encountered this or who just sees warrants as a bad word, let's break it down. What actually happened?
So think of a warrant like a coupon. It's a coupon attached to a stock that gives an investor the right to buy shares at a specific fixed price in the future.
And usually companies issue these to sort of sweeten a deal when they're raising money because investors don't quite trust the stock on its own.
Correct. And that's why investors usually hate hearing about them. It means dilution is coming, your slice of the pie gets smaller.
Right.
But context is everything here. Sellas raised about $31 million in gross proceeds from these warrants being exercised. That's for around 22.4 million shares.
So typically, a company running out of cash does a secondary offering, right? They sell new stock at a discount, which just crushes the share price. Is that what happened here?
No, and that is the critical distinction. This was not some desperate secondary offering at a discount where the company is begging for money.
So what was it?
These investors chose to exercise their warrants. They chose to cash in their coupons and buy stock because the stock price was doing so well. This is capital flowing in at peak prices. It's a sign of strength, not weakness.
So instead of the company going out hat in hand, investors voluntarily handed over cash because they wanted in on the action.
Precisely. And that $31 million is a game changer for them.
You see that $31 million as a runway?
Absolutely. That cash creates a buffer. It funds their operations and, most importantly, the crucial clinical trials we need to talk about. It stabilizes the whole ship.
And what's the market cap sitting at now?
It really depends on the day. It's been floating somewhere between, say, $211 million and up to $520 million.
That's a huge spread.
It just shows you how volatile the valuation is right now. But having that cash in the bank removes the immediate fear that the company goes bankrupt before they can even read out their data.
Okay, so they have the cash to keep the lights on for a bit. Let's talk about what they're spending it on. What is the actual product? Because in biotech, if you don't have the IP, you've got nothing. What's the moat?
The moat is built on two main assets. The first is galinpepimut-S, which they just call GPS.
GPS, okay.
The second is a compound called SLS009.
Let's start with GPS. It sounds like a navigation system, but I assume it helps the immune system navigate.
That's actually a perfect way to put it. It's a targeted cancer immunotherapeutic. Specifically, it targets the Wilms tumor 1 antigen.
All right, let's break that down. Wilms tumor 1 antigen, what is that in plain English?
Imagine cancer cells are wearing a specific type of coat that makes them invisible to your immune system. Wilms tumor 1, or WT1, is a protein that's overexpressed in a lot of blood cancers and even some solid tumors.
So it's a marker.
It's like a beacon, a flag that the cancer cells are waving, but the body just ignores it. GPS is designed to train the patient's immune system to recognize that beacon and attack any cell carrying it.
So it teaches the body to hunt its own cancer.
Exactly. It's an off-the-shelf vaccine, essentially. And right now, the big story is the Phase 3 REGAL study. They're testing GPS for AML.
Acute myeloid leukemia.
Yes, specifically for maintenance therapy.
And we have to put this in context. AML is a notoriously tough area. People call it the graveyard of drug discovery. There haven't been many wins there.
Which is exactly why the potential payoff is so huge.
Right.
If they can show efficacy in keeping AML patients in remission, keeping the cancer from coming back, that's a massive medical breakthrough and a financial blockbuster.
Okay. And you said there was a second asset.
Right, don't sleep on the second one, SLS009.
That's the CDK9 inhibitor.
Yes.
Okay, CDK9 inhibitor. We need another analogy. What is CDK9 and why are we inhibiting it?
Think of a cancer cell as a runaway photocopier, just constantly making copies of itself.
Okay.
To do that, it needs instructions. CDK9 is like the manager that approves those instructions. Specifically, it regulates the genes that keep the cancer cell alive and resisting death.
So SLS009 fires the manager.
It shuts down the manager. By inhibiting CDK9, you're essentially cutting off the cancer cell's ability to repair itself and keep growing. You're forcing it to die.
And that's the one they just presented data on.
Yes. At the ASH 2025 conference, that's the American Society of Hematology, it's basically the Super Bowl for blood cancer conferences.
And the data was good.
They showed positive Phase 2 overall survival data. In one cohort, the median overall survival was 8.9 months.
8.9 months. To the average person, that might not sound like a long time.
But in the context of relapsed or refractory AML, these are patients who have failed other treatments. They're basically out of options. In that context, 8.9 months is a very strong signal.
It's about buying quality time.
Exactly. And I see in the notes here, they also have an agreement called Impact AML.
Right. That partnership, it validates their reach. It shows they're getting plugged into major research infrastructures. And that potentially blocks generics down the road through data exclusivity. So you have a Phase 3 asset on the verge of a readout, and a Phase 2 asset showing strong survival data. That's the moat.
Okay, I see the science case. High-risk targets, but strong mechanisms of action. But let's pivot to the charts. We need to talk about the technicals.
Yes.
Because this stock has not been behaving like a normal stock. It's been on a roller coaster.
Roller coaster is putting it mildly. The momentum here is explosive. In just the last 30 days, the return is over 101%.
It doubled in a month.
And up about 90% in the last 90 days. The stock is pushing right up toward its 52-week highs, which is around $5.18.
And the trend lines look good. The 50-day moving average is at, what, $3.36?
$3.36, so we are well above that, indicating a very strong short-term uptrend. But, and here comes my skepticism again.
Uh-oh.
Look at the beta. We're seeing a beta between 2.25 and 2.63.
And for listeners who don't track beta, let's just quickly explain that. It measures volatility relative to the market. The S&P 500 has a beta of 1.
So a beta of 2.6 means?
It means this stock is more than twice as volatile as the overall market. If the S&P drops 1%, you can expect this stock to drop 2.6% or more.
Right. If the market sneezes, this stock catches the flu. Or, on the flip side, if the market has a good day, this stock catches a rocket.
The current trading range is pretty wide, too, roughly 217 to 359.
It is wide. And looking at the history, I'm seeing some pretty nasty gap downs. It tests these psychological resistance levels and then just pulls back hard.
That's true, but you have to look at the volume on those moves. We're seeing what we call whale activity. There have been sessions with over 8 million shares traded.
And how do we know that's whales? and not just a million retail traders on Reddit.
You look at the block sizes and the timing of the trades. When you see massive blocks of shares moving all at once, that is not retail traders on their phones. That's institutional flow. That is big money positioning itself.
It does cause those volatility spikes, though. When a whale splashes, everyone gets wet.
It does, but it also provides support. You mentioned the gap downs, but look where it came from. The lows were around 95 cents.
Okay, fair.
The underlying trend is undeniably upward, even with all that chop. The floor keeps rising.
It's volatile, but it's volatile in an upward direction lately. Okay, let's shift gears to sentiment.
Good idea.
Because with a stock moving this fast, it's all about who believes in the story. You mentioned whales. Do we have any names?
We do, and some very, very big names believe in the story.
Oh, yeah.
We talked about the whale activity, but let's put a name to it. BlackRock.
The BlackRock. The we own everything BlackRock.
The BlackRock. They've taken a 5.4% stake in the company.
Now, we should clarify. BlackRock buys a lot of things passively for their ETFs. Is this a significant holding for them?
It's significant because of the size. When the world's largest asset manager takes position over 5% and has to file that paperwork, it matters. It adds a layer of institutional legitimacy. It tells other funds, hey, this isn't just a penny stock, this is a real asset.
And it's not just the institutions either. I'm looking at the insider filings, which is usually my favorite indicator.
Let me guess, Catherine Bach-Kalin.
You got it. A director at the company. In November of 2025, she bought 63,400 shares at an average price of $1.59.
That was a smart buy, considering where we are now.
It was a huge buy for her. That represented a 154% increase in her holdings. She didn't just top up, she more than doubled down.
And that is exactly what you want to see. There's an old saying on Wall Street, insiders sell for a million reasons. Tax planning, divorce, buying a new boat.
But they usually only buy for one reason.
Because they think the stock is going up.
Oh,
exactly. She sits in those board meetings. She sees the raw data before we do. That purchase is a vote of confidence that, well, that money can't buy. Actually, I guess money did buy it.
And the analysts seem to agree with her. The consensus rating is a strong buy.
And the median price target is sitting at $7.
Which implies an upside of, what, anywhere from 97% to 248% from recent levels.
It's a double your money forecast from Wall Street.
However, we have to look the other side. We can't just drink the Kool-Aid here.
Of course not.
Let's look at the latest market context in our notes. While you have BlackRock buying, there's a very specific bearish note that came out on January 19th, 2026.
I saw that one.
The title was literally, Why I'm Selling Sellas Life Sciences Ahead of the Regal Reveal.
And that headline, that highlights the whole conflict perfectly. It sums up the tension in the stock right now.
Right. The bulls are looking at the partnerships, BlackRock, the insiders.
And the bears are just terrified of the phase 3 risk. They think the trial might fail, and they are getting out before that card is flipped over.
Which leads us perfectly into the risk assessment. We have to talk about the bear case.
We do.
Because if that January 19th note is right, people buying in now could be in real trouble. What's the number one threat here?
Risk number one is the binary event. It's the phase 3 Regal trial, period.
This is the classic biotech trap.
Yeah.
You have a company with no revenue, and everything, literally the entire investment thesis, hangs on a yes or no from a single clinical trial.
Precisely. It's not like a tech company where if they miss earnings, the stock drops 10%.
No.
In biotech, if the phase 3 trial fails, if the drug just doesn't work, the stock doesn't just dip, it collapses. It can lose 70–80% of its value overnight.
And that risk is what's priced in through that high volatility we talked about.
Exactly. The market knows this is a coin toss on some level.
And then there's the financial runway, which I touched on earlier. Yes, they raised that $31 million. But looking at the forecasts, the fiscal year 2026 EPS is estimated at negative 57 cents.
Right. They're going to keep burning cash. R&D is expensive. Running a phase 3 trial is incredibly expensive.
So here's the nightmare scenario. If the trials don't yield results, or even if they're just delayed, they're going to need more money.
And if the stock price has dropped because of bad news, raising that money becomes incredibly expensive.
And dilutive. That cash buffer is great, but it's not infinite.
That's a very fair concern. This is why we call it a burn rate. It's literally money going up in flames to fuel the engine. If that engine doesn't start before the fuel runs out, you crash.
If the science fails, the finances crumble.
They're inextricably linked.
There's also a lot of noise out there. I was checking some of the commentary, and we need to do a bit of a rumor check. Some YouTube analysts are calling this the most underrated biotech and throwing around words like blockbuster. There's even chatter about M&A.
Mergers and acquisitions, right. People see the BlackRock stake and they assume a buyout is coming. They think, oh, big pharma is going to swoop in and pay $20 a share.
And we have to remind everyone listening, that is Blick confirmed. M&A chatter is common in this space. But you can't invest your life savings based on a rumor that some big company is coming to write a check.
No, you can't. You have to stick to the data, not the rumors.
But speaking of the data on the drugs themselves, those survival rates, that's what makes this compelling, despite the risks.
It is. The survival benefit they showed isn't just statistical noise, it's clinically meaningful.
So we have a company with massive momentum, heavy institutional backing, but it's facing a binary event that could wipe it out. We need a verdict.
Okay.
You've looked at the growth potential, the science, the money. What's the final score?
Taking everything into account. The risk, the reward, the institutional confidence. I am awarding Sellas Life Sciences a bullish score of 8 out of 10.
An 8. That is incredibly confident for a pre-revenue company.
Yeah.
Walk us through the thesis. Why an 8 when there's a binary risk hanging over their heads like a guillotine?
Here's the elevator pitch. You have a stock that's offering 100% plus upside just to hit that $7 analyst price target.
Okay.
The catalysts are clear and they're imminent. The GPS Regal readout and the continued momentum from SLS 009.
And the cash position is key to that.
The $31 million cash infusion is the key. It buys them the time they need for those catalysts to actually hit, without the immediate threat of heavy dilution. That removes the biggest short-term bear argument.
If they didn't have that cash.
I'd probably give them a 5, maybe a 6. But with that cash, they control their own destiny for the next few quarters.
And you think the bearishness around the Regal trial is just noise?
I think it's short-term fear. The bearish noise is people hedging their bets. But when you look at the smart money BlackRock, the insiders doubling down, that suggests the people who know the most are betting on success. Insiders do not double their position if they think the trial is about to fail.
So what's the play here for someone listening? How should they approach this?
The target horizon is twofold, really. You could look at this as a swing trade into the March 2026 earnings and the Regal reveal.
A 3 to 6 month window?
Right, where the anticipation alone could drive the price up. This is the buy the rumor phase.
And the second option?
You hold. Multi-year for FDA approval and full commercialization. That's the hold for the news strategy. It's much riskier, but that's where the potential 10x returns come from.
You're saying buy the rumor and maybe hold for the news if you have the stomach for it.
Exactly. It is high risk, undoubtedly. But the reward profile here is skewed heavily to the upside, in my view.
High risk, high reward. That seems to be the motto for Sellas. Look, seeing a company up 323% in a year is always tempting. But as we've seen, that volatility cuts both ways. The Regal trial is the main event.
Yeah, everything.
If they stick the landing, that $7 target might be just the beginning. If they miss, well, that moat dries up pretty fast.
That's the biotech game. But with the data we have today, the odds look tilted in their favor.
All right, we're going to leave it there. A fascinating look at a company right on the precipice of something big. As usual, before we go, please subscribe to the channel. We're digging into market movers like this every week, and you don't want to miss the next breakdown.
Thanks for listening.
See you next time.